Reserve Bank of Australia has announced no change to its interest rate at its latest meeting. However, it's also said that there are no rate cuts coming in the foreseeable future. But then we have the markets saying, no, the RBA is wrong, rate cuts are coming this year. So who do you believe? That's why today we need to go and look at the data. We need to look at exactly what's happening to the economy, what's happening to unemployment, so that you can then decide what's going to happen to interest rates and ultimately what this all means for property prices. Let's dive in. Hello, it's Nero here, and if you're new to my channel, hit that subscribe button because I talk about all things related to the economy and the Australian property market. As I just mentioned, the RBA has said no rate cuts coming in the foreseeable future. To me, that prediction seems to be about as reliable as what the previous Reserve Bank governor said back in 2021. You might remember he said no rate increases until 2024. But then what happened? In 2022, Australia experienced one of the steepest rate hiking cycles in history. And now we have the current RBA governor predicting no more rate cuts. Let's have a look at what inflation is doing. Here we have data from Melbourne Institute and CommSec looking at the progress of disinflation. In other words, how quickly is inflation falling? And what you can see is that the annual growth rate has dipped from 3.2% in June to 2.8% in July, the slowest pace since December 2021. We're currently at a 31-month low. So inflation is definitely falling away very, very quickly. And there are many leading economists who expect that inflation could easily fall between the 2 to 3% band that the RBA wants by the end of the September quarter. Now let's have a look at petrol prices. Again, the source of this data is CommSec, and what you can see from this chart is that petrol prices are falling. No, they're not falling in a straight line. There are peaks and troughs, but the general trend is downwards. Now, petrol prices have a big impact on the cost of so many things in our economy. Not just how much it costs us to fill up our own petrol tanks, but everything else that requires transport and travel. So what this shows you is that inflation is falling and petrol prices, one of the core components of inflation, is also falling. But then what about unemployment? Well, if we look at this next chart, the source is ANZ, Indeed, and again CommSec, what we can see is that Aussie job ads have fallen for 6 months in a row now. And what does that mean for unemployment? Well, when you look at this next chart from Macro Business, which tracks unemployment rates against job ads, you can see here that there's a direct inverse correlation. So what that shows you is that when job ads increase, unemployment falls, or that's why it's inverted here. But on the flip side, when job ads decrease, unemployment increases, and we can start to see that here on the chart. And in fact, there's actually a bit of a gap appearing, which shows that unemployment is actually starting to increase. And we know that we've seen the data, unemployment is sitting at 4.1% and increasing, but it's not a disaster. As you can see from this chart, unemployment has often been at 5% or higher multiple times throughout history, and the economy has been okay, and property prices have continued to rise during those periods of time. I'll come back to what I think is about to happen to property prices, but why am I talking about inflation rising and unemployment rising? Well, these are the two triggers the RBA needs to cut interest rates, and that's a big part of the reason why the market is saying interest rates are coming potentially as soon as the end of this year. RBA versus the money markets. It's fair to ask, what do the narrowly focused, hugely specialized economists and analysts at the RBA know that agile and insightful global investors pumping hundreds of billions of dollars a day into the financial markets don't know? It's an important question. The week that the RBA missed. The past week has been tumultuous for money markets and readings on the global economy. But somehow worryingly, the RBA forecast that Governor Bullock was defending had been signed off on the 31st of July, before the market-moving US labor market data for July. The weakness in the US economy was confirmed with news that the unemployment rate rose to 4.3%. Such is the concern about the US economic performance and outlook that markets are currently pricing in more than 100 basis points of interest rate cuts in the US before the end of 2024 and close to another 100 basis points through 2025. So put another way, the market is expecting interest rates in the US to be cut by a massive 2% in just the next year and a bit. The RBA, though, painted a remarkably positive view of the labour market. Its forecast for the unemployment rate to peak at 4.4% is within spitting distance of the current 4.1%, with Australian GDP growth weak and in annual terms set to slip below 1% in the June quarter, job vacancies in free fall, and already a rise in unemployment from 3.5% low in 2023, it would be more than miraculous for the unemployment rate to peak at the rate forecast by the RBA. This is the one issue that investors are giving a lot of weight to. So what the market is saying is that unemployment is likely to rise faster than the RBA expects unless the RBA drops interest rates. You've even got CBA who are saying that interest rates could drop as soon as November of this year because of how quickly inflation is falling and unemployment is rising. So I fully expect that interest rates are going to fall at some point between, say, before Christmas and February, sometime between the next 4 to 6 months. So then what does that mean for property prices though? Well, consider this. After reaching a low point in January of 2023, multiple markets around the country have risen significantly in terms of our capital cities, as you can see here. Sydney, Brisbane, Adelaide and Perth have all risen anywhere from 15 to 30%. Now that's at a time when interest rates are at the highest they've been at for over 12 years. Many people's borrowing capacities have been totally smashed and people can't afford as much as they could 12 months ago. Now, at the same time, as you can see from this chart, with data from AMP and the ABS, or the Australian Bureau of Statistics, we have a massive property shortage right now. It's expected to reach 300,000 by the end of this calendar year. So we have a massive property shortage. Property prices have already risen despite the fact that affordability is at all-time lows and people's borrowing capacities have been reduced. Now, what if interest rates then start to fall? Well, then that increases people's borrowing capacities. People who right now want to buy property but can't afford to, some of them will be able to buy again. That will then increase demand on the property market at a time when our building approvals, as you can see here, are falling through the floor. We're in this weird situation where we are building fewer homes at a time when our population is growing, which means that demand is increasing while supply is falling away in multiple areas around the country. Then when you increase demand because you have more people with more borrowing capacity, what do you think that will do to property prices? I fully believe it will turbocharge property prices in multiple areas around the country, especially those that have a property shortage right now. That's why I'm of the opinion that the remaining few months of 2024 could be one of the greatest buying opportunities of your life if you can afford to buy an investment property right now. I believe that in 2025, prices will rise even more quickly than they have in 2024 and 2023. However, they're not going to rise equally everywhere. You do need to do your due diligence. You cannot buy blindly. And if you want help to find out how do you work out the best areas to buy, check out the link in the description below to get totally for free the audio version and digital version of my book. Otherwise, I'll see you next time.